Okay, Business 720 folks, here is lecture module 5D, and that's going to right to the investment criteria that I call below the line investment criteria. And the first one of note, I'll label it D, okay, following from our previous lecture. This is called payback. Okay, so the decision rule is this. Basically, all right, call it DR, right? Take projects that have payback periods okay, payback periods less than the required payback period all right. And of course, the analogous, otherwise rule to complete the logic would be, right, to basically reject projects that have payback periods that exceed the required payback period. And what happens here is the manager, right, decides what would be the required payback period, right? So it's not market determined. Someone might say something like, well, only those projects that have payback periods, for example, 3 years or less would be acceptable. So this, of course, asks a question immediately. Why would somebody pick 3 years rather than 2 years or 5 years and so on? Now, there, of course, the two virtues, the two pros of payback period. One, of course, is it's easy. Being easy, it's actually quite widespread in use. Also, it does use project, cash flows. Because you have to identify the cash flows to see when you're paying off your investment. Now, sometimes managers say there's a third virtue, that payback favors projects with a rapid rate of capital return, or what we call investment outlay. The observation is generally true, but there's a cost in shareholder wealth that is the result of application of this rule. Say, if you bought a T-bill today and you sell it for the same price tomorrow, you have a payback of 1 day. Now, the question really that matters is, did you increase your wealth in the process? Right? So, just having rapid accumulation of the return of capital is not really what shareholders are hiring managers to do. Right? That's not the goal. The goal is that managers should be maximizing wealth. Right? The timing of cash flows, of course, can be adjusted by using the capital market. Right? If you look in Ross, Westerfield, Jaffe, there's a table under this topic of the payback, and you see it's basically kind of a basic context. Okay, and you should be able to just look at that and kind of understand. Oh, here's a payback method. And note, it doesn't really satisfy our 3 basic criteria for judging capital budgeting techniques that we identified earlier in this week's set of lectures. And then, of course, there are weaknesses. So these are the cons, the minus side, right, to payback. Right, so the first one is that we're ignoring the time value of money. Right, it ignores the time value of money. A second issue is that the cash flows beyond the payback period, okay, those are also ignored, right? So we'll say it this way, it ignores cash flows beyond the payback period. And remember, we are trying to be managers who have a comparative advantage in decision making. Better decisions require the use of full information. Third issue, right, is that this methodology does not consider risk in our assessment of the project. We're not thinking about the risks associated with the project. And right, I think it's very important to note that having a required payback period established by managers, that's actually an arbitrarily determined criteria. Right, we're not using the time period that we say is satisfactory on the basis of feedback from the market. Right? It relies on what we'll call management fiat. So it's somewhat command and control in its orientation. So some people say, well, let's use what we'll call the discounted payback. Does it solve the problems? It does solve one problem, but not the rest of them. It still suffers from problems, right, regarding the ignorance of the cash flows, the issue of risk, and the reliance on fiat, right? So it doesn't work well to just make one adjustment to what we'll call a broken tool. And look, as long as you're discounting cash flows in the first place, let's do it right and discount all of the cash flows, all of them, right, at a market-determined risk-adjusted rate, and that's using the net present value, right? All right, so that's payback. Let's look at the accounting rate of return. Right, so accounting rate of return, well, we can label that ARR. Also fairly popular. Here's the decision rule. For this one, take projects, right? Say yes to projects, right? With accounting rates of returns, we'll call it ARRs, that are greater than the required accounting rate. Greater than the required accounting rate. And of course, then reject projects that have ARRs that are less than the required rate. Where does the required accounting rate come from? Again, it's specified by management. It is not market determined. Somebody might say, well, we're only going to take projects if they generate an accounting rate of return of, greater than 30%. Again, where is the number coming from? Accounting rate of return is simply the average net income over the life of a project divided by the average investment in the project. So let's do an example. Suppose you have a project, let's say it has a 5-year life, and it has after-tax earnings. Okay, so we got a 5-year life. Let's imagine the after-tax earnings run 50, 60, 60, 50, and 40. Now the average across the 5 years, right? The average earnings, that comes to $52. Right? That's the sum of the years divided by 5. Okay, so we got $52 average earnings. Suppose the project requires assets with a net book value running like this. So call it net book value. Let's say it runs 200, 180, okay, 160, 140, and 120. And that's what's happening at the start of each year over the 5-year life. Here the average book value of this investment is 160. See? The average book value is 160. Again, the sum of the book values divided by 5. So the accounting rate of return is the average earnings over the accounting or average book value, right? So ARR here run across this 5-year project. Okay, so 52 over 160. So that's 0.325, right? Or we could say, right, 32.5%. Right. Now, suppose management said, it has to be the case that a project that is going to be greenlit, that it has to have a 25% rate of return. And so we would say, oh, good, this is a project that would be accepted under such a rule, right? Now, there are weaknesses. Again, it doesn't focus on cash flows. So right that way, no focus, right? on cash flows. Even payback is using cash flows, but this isn't. Another issue, it does not consider, again, the time value of money, even for accounting of the profits, right? So there's no consideration of the time value of money. Also, it doesn't adjust for risk. Like how risky is the project compared to other projects we might invest in. And so it lacks that tool. And right, once again, it's using an arbitrarily sort of specified cutoff rate. Again, it's dealing with management fiat to determine whether the project is attractive or not. So that's accounting rate of return. Let's just throw in some conclusions here. What should I take away? What should I take away here? Some conclusions. Let's kind of demarcate these nice and brightly. Is that a word? I don't know. So, bright yellow marker here to just kind of give a little bit of a summary as we close off this week's section on net present value and investment criteria. We'll deal with some capital budgeting next. So, right here you've got the variety of capital budgeting techniques, and you should be able to understand basically their strengths and their weaknesses. And we've discussed, right, 5 methods. The NPV rule, right, a profitability index, an internal rate of return rule. Then we dealt with payback. And briefly, I just mentioned something about the discounted payback also, right? And we did accounting rate of return. So you should be able to basically understand these, kind of know them intelligently, be able to persuasively defend use of the NPV approach as the ideal. Okay, and so this particular lecture I'm going to put up on Blackboard for you guys now. Okay.